All right, welcome to The Explainer. Today we're jumping into a super common but really expensive tax mistake. We're talking about misclassifying settlement income and how it can accidentally throw you right into what I call the self-employment tax trap. It's a big deal, so let's get into it.
So here's how we're going to break this down. First, we'll look at the framework of the forms themselves. Then, we'll get into what this settlement income actually is. We'll talk about the mess with 1099s, the huge tax trap it creates, and then, the most important part, the solution to get out of it.
So picture this, your client gets a settlement check. Awesome, right? But now you've got this question. Where on the 1040 does this money actually go? And believe me, this isn't just a simple box-checking exercise. Your answer right here could be the difference between them paying their normal income tax or getting slammed with an extra tax that can top 16%. Yeah, get this wrong, and you've just walked your client straight into a very expensive trap.
Okay, first things first. To even begin to untangle this, we've got to get our heads around the way the modern 1040 is built. You see, the key to this whole problem, and the solution, it's all hiding in one single but absolutely critical schedule.
You know, the 1040 these days is kind of modular. It's the main page, sure, but then you have all these numbered schedules that bolt on. And for our purposes, Schedule 1 is the big one. It's basically the clearinghouse for all the weird stuff, additional income, and those above-the-line deductions. So you've got Part 1, that's where extra income goes, think business income, alimony, stuff like that. And then Part 2 is for adjustments that lower your AGI. It's really the place where all these complex financial events get translated into actual tax numbers. Okay, and digging into Schedule 1, there is one specific line you've got to burn into your memory. It's line 8Z, labeled Other Income. Now, you can think of this as the miscellaneous drawer of the tax code. It's the catch-all for any money coming in that doesn't have a nice, neat box somewhere else. Seriously, remember 8Z. It is the absolute key to this entire discussion.
All right, so we've got this other income line, but what does that have to do with a legal settlement? Well, here's the thing. To report a settlement payment correctly, you can't just look at the dollar amount on the check. Tax law forces us to go deeper. We have to look at the why behind the money, the legal foundation of the entire dispute.
And this brings us to a foundational concept in tax law called the origin of the Claim Doctrine. It sounds fancy, but the idea is actually pretty simple. The tax treatment of the settlement money isn't based on the fact that it's a settlement. No, it's based on what that money is replacing. You have to ask, is this money replacing lost wages from a job? Is it replacing lost profits from a business? Is it punitive damages meant to punish the other party? The answer to that question is what decides how it gets taxed.
So let's see how this plays out in the real world. Take a look at this. Compensation for lost wages. That's ordinary income. Punitive damages? Also ordinary income. But here's the absolute critical part. Look at where they're supposed to be reported. Schedule 1, line 8Z. Yep, our other income line. It's not automatically dumped onto a Schedule C for business income. And that single distinction, well, it changes everything.
Okay, so if the law is that clear, where does everything go wrong? Well, the problem gets a whole lot bigger when we look at how the person or company paying the settlement reports it to the IRS. There was a recent change in the forms, and honestly, this is what blew the doors wide open for this huge tax trap. It really comes down to a tale of two forms. You see, before 2020, pretty much everything like this went on a Form 1099 MISC. It was a broad, catch-all form, and the other income box was pretty neutral. But then, the IRS brought back the Form 1099 NEC, specifically and only for non-employee compensation. And that changed the game. Now, the IRS, and just as importantly, all the tax software automatically presumes that any dollar reported on a 1099 NEC is self-employment income that belongs on a Schedule C.
But this is the one thing you have to tattoo on your brain. The payer's choice of form does not dictate your client's tax reality. A 1099 is just a piece of information. It is not a legal directive. The tax treatment is based on the actual facts and the law, the origin of the claim, not just on which box the other side decided to check.
So, let's ask the question. What's the big deal? What happens if you just go with the flow, accept that 1099 NEC, and let your software dump it onto a Schedule C? Well, you've just pulled the trigger on a nasty and completely separate tax cascade.
And let me be crystal clear here. We are not just talking about their regular income tax rate. This is a whole other tax, a second, parallel tax that gets piled right on top of everything else.
The second that income lands on Schedule C, this tax calculation becomes mandatory.
And here's what it looks like. We're starting with a baseline of 15.3%. Ouch. That's made up of the 12.4% for Social Security up to the annual wage base and the 2.9% for Medicare with no income cap. That's the first hit, the first layer of this nasty trap.
But wait, it gets worse. For your higher income clients, the trap has another level. Because on top of that 15.3%, you can get hit with another tax, the Additional Medicare Tax. So if this settlement pushes your client's income over certain thresholds, and we're talking about $250,000 for joint filers or $200,000 for single folks, bam, they get hit with an extra 0.9%. You add that all up, and a simple misclassification has just cost your client an extra 16.2% in tax. That is a staggering amount of money to just give away by mistake.
Okay, so we've laid out the problem. We've seen just how bad the consequences are. Now, for the good part. Let's talk about the solution. Here's the legally solid, by-the-book way to get your client out of this mess.
Our entire argument, our whole defense, it all comes down to the legal definition of a trade or business, right out of IRC Section 162. And the two magic words here are continuity and regularity. Think about it. For most people, a one-time settlement for lost wages is, well, a one-time thing. It's sporadic. It doesn't have the continuity or regularity that the law demands for it to be called a business. It just doesn't fit the definition.
And that brings us right back to our escape route. This is where you, the tax professional, have to step in and take control. You can't just let the software do its thing. You have to manually override it. You take that income from the 1099 NEC and you report it on Schedule 1, Line 8Z, as other income. That one simple manual entry completely disconnects the payment from the whole self-employment tax world.
So let's just recap exactly why this is the right move. First, you're still correctly reporting it as taxable ordinary income, so you're fully compliant with the law. But by putting it on Line 8Z, it never even gets near a Schedule C. And if it's not on Schedule C, then Schedule SE, that's the self-employment tax form, it never gets triggered. Just like that, the 15.3% tax, gone. That potential 0.9% extra Medicare tax, also gone. You're simply aligning the tax return with the legal reality of what the income actually is.
So at the end of the day, after all this technical detail, it really boils down to one big question. What's our job as professionals? Is it just to be data entry clerks, taking numbers from one form and plugging them into another? Or is it to be true advisors, to understand the facts and to apply the law correctly? Because that 1099, it's just a piece of information. It's not the final word. You are.